As we wrap up the first quarter of 2025, I wanted to bring on John Burns of John Burns Real Estate Consulting to help us make sense of what is going on regionally in the housing market and the economy. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today, we are talking to housing market expert John Burns. We're going to talk about markets that are rebounding, those that are seeing some softness. We're also going to discuss where we are in the current housing market cycle, the cost analysis of renting versus owning a home, if there's going to be a recession this year, and what's going on with those sticky mortgage rates. Make sure to stay till the end because we'll discuss what's going on with the multifamily market as well. John Burns, welcome to The Real Wealth Show again. For our audience who I doubt don't know who you are, but for anyone who doesn't know who you are, could you just explain a little bit about what your company does?
Yeah, I started the company 24 years ago to figure out what's going on in the housing market for housing industry executives. And so we've got a large research business that's for big businesses, and we have a large consulting business that helps people make big investments like huge land home communities or land development communities or portfolios of single family rental homes. We do not help individuals buy their house.
And I think I told you on the last time you were on, but you are consulting for one of our projects, the Mirada in Florida. And we made your list last week of the top selling subdivisions in the country.
Oh, wow. Yeah. Congratulations. That's not easy to do.
It was number 8. Yeah, because it has a crystal lagoon. It's in Tampa. And we had 129 sales in just the first two months of this year. So things are going good in spite of.
I've never set foot in a crystal lagoon. I've seen them, but I need to get in. Is it fun? It must be.
It's beautiful, and there's no alligators, or crocodiles, whatever they have there in Florida.
They can go in though. That's one of the issues, but you can see them because of water.
You can see them. That's the difference. Okay. It's crystal. So yeah. Anyway, we really appreciate all the guidance and we've had on that project, and I've been following you for years, probably 20 years now, probably just a few years after you formed your company. And you have just been so thorough in your research, so helpful to so many real estate investors trying to navigate the constant changes in the real estate market. So you're out with some new data. If you would just kind of tell us a little bit about your most recent report, the Q1 Housing Market Recap.
We publish like 2 reports a week. I'm not even sure which one you're referring to. We've got 150 people trying to figure this out. So it's getting, I started the business back when you started following me when there was no data. Now there's like too much data. So we're just filtering it all the time. But you're asking how's the market doing? The spring is doing fine. It's the slowest spring we've had in about 6 or 7 years, but we had 6 or 7 great years. So it's very regional. It is not a national housing market anymore. I started the company because that was always the case. It was always regional and helping our clients put their money in the right market and pull back on other markets. And I think we're heading into we are in the same situation right now where some of the strongest markets in the country the last 6 or 7 years are now some of the weakest and vice versa.
Well, and that's what's been so helpful and why I've been following you for so long is most of the information that people follow is national data, and that does nothing. It's like I'm literally in Utah right now where it's winter. There's a huge storm. If you're in California, I'm guessing where it's probably summer. So why on earth would you have you wouldn't have a national weather report? Why would you have a national housing report? And you dive into the details, and it's so helpful. So let's dive into a little bit of what you just said. Some of the strongest markets are the weakest. Which markets are those that are now the weakest?
It's the smile states where everyone says everybody's moving, and Texas has been the weakest. The big difference, and I was just looking at this yesterday, the job growth in the economy in Texas is still good. It's just not as awesome as it was the last 3 or 4 years ago. It's still good. But we built so many homes, and frankly, there were a lot of investors that piled in. They've always been in Florida, but they piled into Texas this time. So we've seen a lot of new home construction, The exact opposite is the rest of the country. All-time high level of new home construction in Texas, where the rest of the country is not even close to that. And we're seeing a surge in listings, I think, by investors who have said, my home's not going up in value anymore. My property taxes are going up. I can get a 5 with a T-bill. Maybe now's the time to sell. And you tell me what they're doing, whether they're paying taxes or probably 1031ing it into something else. And in Florida, the same thing, although I would say it's more investor-driven listing increases, supply increases than new homes.
Well, when you dive into Texas, it's a big state.
Yeah.
So is that across the board? Are there certain cities doing better than others?
Well, no, I'm very generalizing here. So Austin boomed. Well, first of all, I think you need to remember that Texas did not get hit as hard during the great financial crisis, actually because there were laws against how much you could refi, the LTV. So it just didn't get as bubbly and as down. So it boomed early. Austin also saw a huge tech migration out of really affluent Northern California. So people were happy to drive prices up in Austin because it was so much cheaper than Northern California. And when we started to see a tech correction a few years ago, Austin got hit. The migration stopped and they got stuck selling to locals and they couldn't afford it. So Austin's that's still playing out there, and it's probably even more significantly on the rental side. And then San Antonio is more of a government border town, defense contractor type, very affordable, hugely interest rate sensitive. A 50 basis points increase in mortgage rates really hurts the San Antonio consumer. So it, unlike Austin at all, it didn't really boom other than when mortgage rates fell. And then when mortgage rates went back up, all of a sudden the locals couldn't afford it. So that's been the problem there. Houston has been a little bit more of a steady eddy. It's doing okay. Dallas was by far the strongest economy in the country for years. And now it's everybody piled in. Everybody's going to Dallas. And now it's just growing half as much as it was, which is still good growth. But there's been more homes under construction than ever before. And it tends to be pretty far out there. And so it's just getting more competitive.
Yeah, that makes sense. So then in Florida, I like I said, we have this project in the Mirada. It's north of Tampa, about an hour. There's a lot of development going in there. We sold over 120 homes in just 2 months. That's pretty phenomenal in that subdivision. Are people kind of moving out of certain areas into more central Florida areas to stay away from the hurricanes? I know Sarasota's been hit pretty hard. But again, which cities are doing better than others in Florida?
I think it's even more local than that. Whose homes are elevated 10 feet and whose aren't.
Right.
Seriously, because that's the difference between flooding and not flooding. It's more of a flooding issue. We're northern Florida, and that includes Jacksonville and Orlando, are some of the softest markets in the country right now. And we've been scratching our heads as to why. I think some of it's investor driven. Some of it's the halfback. I'm going back to Carolinas after dealing with this. But that one honestly has caught us by surprise. It sounds like your project hasn't slowed that much, but most of the projects there have slowed.
I think it's just because there's so much growth around ours, and it's cool. It's got a crystal lagoon. Where do you get that?
Well, it's a buyer's market now. So if you've got a crystal lagoon and the competition doesn't, you have an advantage.
Well, you also track the rental market, and I don't think you were doing that when I first started following you. But one of the main reasons I started investing in Dallas 20 years ago was because of you, and because you kind of showed how the income was so strong and wage growth was so strong, and yet home prices, I think at the time you had a report that showed we're about 26% undervalued. I don't know.
Okay.
It was 20 years ago, but over the last few years, you've been doing surveys on the rental market, kind of seeing if cash flows are changing. Are you seeing the same dynamics on the rental side as the home price side?
Pretty similar, although you alluded to it. I mentioned how strong the economy was in Dallas. It's high-paying jobs that have been strong too. So it used to be kind of a lower-paying back office attract people. Now it's multiple six-figure jobs in the Dallas metro area. And one unique thing to Dallas is there's a lot of the apartment companies headquartered there. So people tend to like to do projects in their own backyard. So you saw a lot of apartments. You saw a lot of this build to rent in Texas, a lot of it. And also, if you think about it, it's also a heavy relocation market. And so if you're a homeowner and you're relocating to Dallas, you're probably going to rent for a year or two just to make sure you like it. And maybe you were stuck renting an apartment even though you're coming out of a house, and now you've got a chance to live in a brand new house and rent it. That has just boomed in Dallas, and it's a bit oversupplied right now. So the market there is soft, but over the long term, I'm still very optimistic about that.
Yeah, especially it seems like as growth goes out into the outskirts of Dallas, it just gets too expensive for builders to make the numbers work, so they keep moving out, and people move out because they could afford. That's how we've made the numbers work. Is we're certainly not investing in Dallas Central. Well, the housing market is always shifting, but how would you say we compare now with, say, a year ago?
Um, the biggest difference, well, there's two differences. One is we're seeing some investor selling, so we're seeing listings up, not crazy, but up. Uh, but the bigger difference is in the new home market, and for the first time in 12 years, the builders have more standing unsold homes than they want. So, and they're publicly traded companies; they can afford to discount. So there's discounting, and the price declines that we've seen lately have been driven by the home builders, and of course that impacts the resale next door. And they're doing it a little bit with price declines, but their biggest thing is they're offering 150 to 200 basis point lower mortgage rate. So the builder will write a $16,000 basically check up front to buy down the rate for all 30 years. And I think and so people are looking at that, and then they look at the resale market, and they're choosing new. So new is taking market share.
Yeah, that's been our model, is going to these builders who have too much supply, getting them to buy the rate down to as low as 4% in some cases, sometimes even 3%, and that really makes it cash flow. And we found that to be a great opportunity for investors, because a renter would sure love to live in a new house too, and even if they can't afford to buy it. You usually have really good charts showing the difference between what it costs to own a home versus rent a home. And I know recently, maybe it was last year, it was dramatic. The difference between renting and owning made a lot more sense to rent than to own in a lot of places. Is that still the case?
Very much so. So I'm going to quote national numbers here again, but it's all local. But it's usually about $200 to $300 more per month to be a homeowner when you throw in the property taxes and everything else. It's $1,200 more per month to be a homeowner, right?
Wow.
So huge rental demand, just because it's so much cheaper.
Yeah, yeah. So if you can get that deal, get the rate down, you can make the numbers worse. You can make the numbers work.
Right.
All right. We've started to see rates come down a bit this year. There is some talk that the Q1 GDP is going to be negative. I don't know if you've heard that or agree with that. Do you think it will be?
I don't know if it's going to come in negative, but our odds of a recession, as long as most people's, have increased.
Okay.
I mean, you see what's going on, and the federal government is laying people off, and I think it's giving a lot of companies kind of permission to start looking around and doing a little trimming too. So I think you're going to see a lot more layoffs the next couple months. And then all the uncertainty around tariffs, and there's so many businesses that rely on tariffs, either importing or exporting. Whether it's going to be officially a recession or not this quarter, I'm not sure, but I'm positive job growth is slowing.
Yeah, especially in towns that have a lot of government employees, which is a lot of places.
And it's not just Washington, D.C. I mean, it is all over the country. We've been looking at it. There are defense contractors everywhere, and there's probably far more private companies that rely on government spending who are getting cut.
Yeah, it's so hard to know who to believe, but some people will say, right. That's why I listen to you because you've got the facts and the data. But some people have said that a lot of the job growth of the last 4 years was government jobs, and now the trimming is only, I don't know, 10% or so, and it won't have that much impact. And other people say, oh no, it's going to lead to a complete recession. I mean, where do you stand on that?
I mean, a higher than usual percentage was government jobs the last couple of years, but most of it at the state and local level, not the federal level. Um,
Okay.
so, yeah.
Yeah.
I mean,
Okay.
if you remember coming out of COVID, everybody was blaming like everything government wise was moving very slowly. And so the state and local governments didn't do any hiring during the early years of COVID and had to do some catch up.
Got it. Okay. So if things are slowing down, we might continue to see mortgage rates come down. Is that your prediction?
No. Uh,
No?
yeah.
Okay.
So I
So
should,
things might slow down and mortgage rates might go up. That's an uncomfortable situation.
yeah, well, mortgage rates are tied to the 10-year
Yeah.
and the bond market. You can look at the futures on the 10-year, and the futures were saying the 10-year will come down a little bit. Now they're saying they're going to come down even less because the 10-year really trades off inflation expectations.
Yeah.
And so you're right; it's a catch-22. And like if we go into a recession, there shouldn't really be a lot of inflation usually, and the Fed will drop rates. But we're talking about a recession here that maybe has a lot of tariffs and a lot of inflation associated with it, which is propping rates up. So I'm not smarter than the bond market. We just look to the futures and say the bond guys are telling us maybe long-term rates will go down a tiny little bit, but not much. Probably the more important thing is the spread over the 10-year is wider than usual right now, and so that you could see mortgage rates come down a little bit. And Bill Pulte now is controlling what Fannie and Freddie are doing. He's Trump's appointee,
Hmm.
and they're kind of talking out of both sides. We're going to privatize Fannie and Freddie, which should push rates up, or we're going to stimulate home ownership, which would have them pushing rates down. So it's still to be determined what they're going to do.
So have you ever been in a time that was this confusing?
No.
No, really?
Yeah, no.
In the past 25 years, this is
Well,
the most
actually,
difficult to predict?
there actually is an economic uncertainty index. I didn't even realize this was a data point until recently, and it goes back like 50 years. This is the most uncertain time in the last 40 years, with the exception of spring of 2020, which was COVID. So,
Wow.
so the answer is, I haven't been in business more than 40 years, so definitely I'm like everybody else. This is more uncertain from an economic standpoint. I'm not sure from a housing's a little more stable in all this. We're underbuilt. The mortgages are pristinely underwritten. The home builders themselves have never had better balance sheets, and so I'm uncertain about the economy. I'm still pretty certain that housing demand is more than supply right now. We're pretty much in balance with supply right now.
Okay. So, yeah, because the headlines will say supplies increased dramatically, which it has. I think, what, 27% or 29% since
Yeah,
last year?
off of like a 40-year low or something like that,
Yeah.
and in Florida and Texas, and not in other areas.
And so that's why you have to read these headlines with a grain of salt because it's not telling the whole story. When you come from the lowest levels of inventory, any change is going to seem massive, but we're
Well,
still
and
in
now with the
normal.
NAR guy, the real estate agents are holding the listings off the market for a while. So I mean, you can't even trust the listings data anymore. So we're trying to figure
Wow.
figure out what's going on there.
Oh my goodness. Okay, so in this scenario where you don't necessarily see rates going down, maybe staying where they are or possibly going up,
Um, I,
who knows? Right?
again, I'm going to follow the bond market. The bond market's going to say they're most likely pretty stable. If you look at the
Okay.
long term averages on everything, we're pretty much there. I mean, the
Okay.
long term average on the 10-year is 4.5, and we're at 4.4. The long term average on mortgage rates going back 50 years is 6.6, and I think we're at 6.5. So, mortgage rates are normal right now.
So if they stay stable, but home prices continue to go up, I don't know, 3%, let's say, and there's inventories rising, where do you see the housing over the next year?
Yeah, it's the economy is what I'm paying most attention to, Kathy. And
Yes.
you started the conversation earlier with recession risk. And so we're looking very closely. Clearly, I think the risk is definitely high in the Washington, D.C. metro area right now.
Yeah.
Um, so it's a market by market view.
Yeah. Are there some cities or metro areas that you would say are more recession proof than others under these kind of circumstances?
Um,
Tough question.
that is a tough question, because the entire Midwest is very dependent on tariffs. And
Mm.
so there's a lot of tariff issues there. You
Why is
know,
that?
um, well, there are a lot of manufacturing companies. There are a lot of
Hmm.
mature manufacturing companies that import a lot of materials that are getting more expensive and export to other countries that they're going to have to charge more. So my, we have a lot of building products clients now, and a lot of them are in the Midwest, and they're very concerned.
Mhm.
And then the Smile states are immigration dependent because people come. There's a lot of people coming across the border, but there's a lot of business going back and forth across the border in the South too, and clearly those businesses are concerned too. So it's for different reasons. I'm going to tell you, there's not one market I think is recession proof.
Wow, fascinating. Even the West.
Um, the West is in fact, the West is holding up better than other areas, probably for some of those reasons. California, in particular, is pretty diversified, um, but the ports are huge employers in Southern California, and clearly they'll be impacted by a change in trade driven by tariffs. So I don't think anyone's got it easy right now.
So the bottom line is we are an economic shift, but we're not really sure how it's going to all play out in the end.
It's a 40-year high other than COVID and uncertainty. I think that's the exact right way to describe it. You're just not
Yeah.
certain.
So what are you telling your builder clients who are still putting up subdivisions with this kind of backdrop?
The big ones are getting bigger, and I think that's smart. So and sad to say, I think the big ones are starting to drive the smaller ones out of business. They're getting great economies of scale. They're at the local level. Because of that, they're getting better pricing from their trade partners. There's financing is much easier for publicly traded companies, whether they're doing land banking or whether they're going to the bond market, than it is for a private builder who has to go to the bank for every single loan. And because of all those advantages, the big companies are continuing to build. And we're looking at them, and it's a community by community thing. So there are certain communities where they're overpriced and they've got 10 completely finished unsold homes. We're telling them you're going to have to discount it, you're going to have to adjust prices here. And there's other communities that are selling really well and they don't have the same issue. So kind of going on and on here, but it's really kind of a community by community decisions for them right now. It's not more of a macro market.
Okay, final question. Multifamily. So many people have been waiting for all these defaults to come so that they can buy multifamily at discounted prices. This is supposed to be the year, and then at the same time you've got oversupply with the new apartments. Where's the multifamily market at this point?
Uh, I don't think the distressed opportunities are as much as people hoped.
Yeah.
So, guys borrowed a lot of money at a 3% or probably at a 5% rate. SOFR was back really low, and now it's 9 or 10. Cap rates have risen from 4 to 5.5. So if just those two things had happened, there'd be a lot of distress. But at the same time, we've seen some very strong rent growth. It slowed recently, but we saw a couple of years of rent growth vastly exceeding operating expense growth. So most apartments' net operating income is in a better place than it was a couple of years ago when they got the great financing.
Mm.
So I'm generalizing here, but I think most communities, there's still equity in the community. So you're not going to give the keys back to the bank, but there's not so much equity in the community that you can sell and make any money on it either. So there's just this kind of limbo situation. And because of what you asked me earlier, rental demand is really strong. So there's a lot of hope that we could see some strong rent growth over the next couple of years, which would help that investment too.
Okay. Well, John, I could talk to you for hours. I know you got other appointments. Thank you so much for joining me on The Real Wealth Show. We really appreciate it.
You bet, Kathy. Take care.
And thank you for joining me here on The Real Wealth Show. If you'd like to find out where our 80,000 members at Real Wealth are investing today and making it work, just go to realwealthshow.com. We have hundreds of free webinars to help you on your real estate journey. I'm Kathy Fettke. Thanks again for joining me here on The Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.